Assalamu Alaikum everyone, welcome back to another video. I hope you're having a wonderful day. As a retail investor, sometimes it is important to look around and do a research and find out what you own and who else owns those companies. I'm talking about the super investors, the hedge fund managers. And what I like to do once every couple of months, I like to look at a website called Dataroma and look at the what the super investors are buying, what stocks they own, how long they own these companies, are they buying, are they selling it? Okay, and then I look at how individual companies and then how many super investors own these companies, and that's what we're going to do today. I looked at basically 10 different companies and looked at how many investors or super investors own these companies, and I put together a quick research to kind of show us what the financials looks like for these companies and what they see in them. The idea is hopefully then we will go away and do our own research to find out a bit more information and see if these companies actually fit into our portfolio. And if they do, then obviously you then go away and do whatever you need to do. And like I've always said to you guys, that is what I like to do. That doesn't mean it's the right thing. It doesn't mean it's also for you, because I'm not definitely a financial advisor. I'm just some guy who's basically sharing his journey. And as you can see right now, £62,000, £507 on my portfolio, and that is the real money that I actually made, alhamdulillah, and actually invested in the last 3 years in this account. And I've shared this with you guys on daily basis. So every time I would do a video, the first thing I do is start with this page, and this account is Trading 212. Trading 212 is obviously regulated by the Financial Services or FCA, and they will basically you are protected up to £85,000. More than that, whatever happens, I guess. But you have to be really careful. Like I've always said to you guys, it's important to invest your own money, okay, and make sure wherever you investing in, okay, you have to do your own research before you invest it. Because look what has happened in the crypto world right now with the FTX and so on. FTX and these companies were not regulated obviously at all. Trading 212 and all the other companies that I use, for example, Free Trade, I was using it a while ago, is regulated by Financial FCA. Is also Interactive Brokers is another one that I use for the family account, where we have as a family another ISA account. Okay, it's really good, that one, by the way. If anyone is interested, let me know. I will maybe just show you very quickly how it works. But it's really good. It's genuinely like you can get an ISA account, just like this one here, and that company is a lot bigger than basically Trading 212. So it's good to diversify your portfolios as well across 2 different platforms. Don't just stick with one. But the one that you're looking at right now is my Trading 212 account. And obviously I want to grow this account to at least 100 grand, if not more, and inshallah see what happens. But like I said, you are protected. It's not like if anything happens to this company right now, your money is not actually sitting with Trading 212 accounts, right? So your money is actually held in another account that is basically the government and the financial authorities are actually in charge of that. So God forbid anything happens to Trading 212, then obviously your money will be safe and up to 85,000, and then everything else. Then obviously you have to go through certain things to be able to basically get you with the rest of your money back. So yeah, you have to be careful where you invest in. As always, I'm trying to be transparent. Okay, just make sure that you are buying companies that you've done research on, and at the same time use brokerages that you've actually know and use. Okay, the portfolio is doing all right. As you can see right now, we are 10% up. Not long ago, I think it was 1%, 2%. It might go back down to those days. Genuinely, if it goes back down to at least a 1%, I would be happy, because right now I'm kind of struggling to look around and see where I can add money to, especially the companies that I wanted to buy more of have gone up quite a bit lately. So if you haven't seen my portfolio update video recently, go and watch that, where I've actually talked about every single stock. So that having said that, let's now look at the 10 companies these super investors own in their portfolios. What we're looking for is the company details, the market cap, whether they have an economic moat, rating of wide or narrow, and so on, what the current price is. We're looking for dividend yield. We're looking for the latest dividend increase, which is important, okay, to see if the company is actually increasing that dividend. This is important to me because I want to make sure the companies that I own are increasing that basically dividends every single year. Hopefully that to start that compound effect, if you like. The 5-year growth rate kind of gives me the historic information that I'm looking for. The payout ratio tells me whether this company will be able to afford to pay me this money. Dividend streak obviously tells me if the company is willing to pay this dividend for a long time and increase every single year. The safety kind of tells me whether that dividend is actually safe. The profit margin tells me if the company is actually heading the right directions, making profit. I don't want companies that are losing money. Return on equity, I want to know whether the company, the management is actually investing the money back into the business, if they're doing well with that money and the profits that they're making and so on. Okay, so it's important that this will help us to understand if the management is really effective management and they're doing the money, the net incomes that they receive is actually being reinvested and paid dividends or whatever they need to do with it. Free cash flow tells us how much cash the company has to reinvest in the business, to pay us dividend, to buy back shares, to pay off debt, and so on. Total returns tells us last 10 years what's been happening to these businesses in the last 10 years. Have they given us a good return? Can we expect more or less the same in the next 10 years? Again, the past does not tell us what might happen in the future, but it gives us at least a good indication. Then we're looking for the growth estimate. This comes from basically Yahoo analyst. Again, when you look into this type of information, these analysts might actually be biased and so on, so you have to be careful. But the next 5 years, we're looking for what is expected from this company in terms of earnings growth. Morningstar valuation. So Morningstar is a company that I use to find out basically how much these companies are overvalued, undervalued, and so on. They are very conservative in terms of valuation, so I do like it, and they have basically quite a lot of information to explain why they've come to that conclusion, and then fair valued for each stock, so how much the price, basically the price you should pay for, basically. Okay, and again, when it comes to these things, it's basically based on their research, so you're gonna have to do your own research. I do like them and I do use a lot, and so far for 3 years I've been with them. To be honest with you, I've actually kind of more or less they've been right about everything that they've said, so we'll see. So the first company, and this company, basically this first company we're looking at is Microsoft, and there's so many super investors that own this company. Almost, I think it was 31 or 28 different super investors own this company in their portfolio. So at least that gives us a good idea. This is a decent company, right? We already know Microsoft, and I own it in my portfolio. It has a market cap of 1.8. It has a wide economic moat, so they have a competitive advantage. Their current price is $245 per share. They have a 1.11 dividend yield. The latest increase and the 5-year growth rate is about 10%. The payout ratio is very low, so that means they have room to increase that dividend. Dividend streaks basically for 12 years of increasing that dividend every single year. The safety is 99%, which is the highest simply safe dividend gives. Profit margin of 34, which is very good, especially for technology companies. That's what you expect anyway. And return on equity of 42%, which is also absolutely amazing. They have a free cash flow of $63 billion, and then they have a total return in the last 10 years of 25%. Growth in the next 5 years is expected to be at least 13% every single year, and right now it's discounted 24%, and $320 per share is where the price should be, and as you can see here is $245 per share. The next company we're looking at is Visa. Okay, a lot of these super investors own this company. $425 billion company. It has a wide economic moat. $210 per share. Dividend is very low. Latest increase was 20%, and they keep doing this a lot. And basically the 5-year growth rate is 18%, which is very nice. Okay, payout ratio 21%, so still have room to increase that dividend. Dividend streak is basically 14 years of increasing that dividend. Safety 99%, profit margin almost 50%, return on equity 44%, and free cash flow of almost $18 billion, and total return of 19% in the last 10 years. 17% growth expected in terms of earnings, and then 10% discounted right now, $229 per share is basically where the price should be. Absolutely another great company. MasterCard is another one. We're very similar to obviously Visa, $325 billion market cap. So it's slightly smaller than Visa. It has a wide economic mode, $344 per share. Dividend is very low, 0.57. And then you've got 11% dividend yield, or dividend increase of 11% in the last just this year, and the 5-year growth rate of 18%, payout ratio 19%, dividend growth streaks of 10 years of increase in that dividend, safety 99%, profit margin 45%, and return on equity 145%. Free cash flow looking about $10 billion, total return in the last 10 years about 22%, and growth estimate in the next 5 years is about 21%. Fairly valued at the moment, $369 per share is where the price should be. The next company we're looking at today is J&J, one of, I think, is my biggest holdings right now, and then $460 per share. $460 billion of market cap, and wide economic mode, $176 per share. Dividend yield of 2.56, 7% growth in terms of increasing that dividend this year, and then in the 5 years basically we're looking about 6%, which is what I normally look for, 6-7% basically. Payout ratio 44%, which is decent. They have increased this dividend for almost 60 years right now. They are a dividend king. Safety 99%, profit margin about 20%, return on equity about 25%, and the free cash flow here we've got about almost 17.7, almost $18 billion. Okay, return on equity we're looking about 11%. Growth estimate in the next 5 years is 4%. Fairly valued right now, $164 per share is where the price should be. Okay, the next company, the fifth company we're looking at is a S&P Global, $113 billion market cap. It has a wide economic mode, $352 per share right now, just below 1% dividend yield, and the latest dividend increase was 10%, 5-year growth rate of 16%, 28% payout ratio, dividend streak of 48 years. Now that 2 more years and they will become dividend king. Safety 99%, so you don't have to worry about it at all. Profit margin about 33%, return on equity 11%, almost 12%. Free cash flow $2.3 billion, and then total return in the last 10 years is about 22%. Next 5 years they're expecting about 8% growth in terms of earnings. Fairly valued right now, $370 per share is where the price should be. Now we're midway through. We've got 5 more companies. Taiwan Semiconductor is another company. One of the people that actually bought this company recently is, or added to their portfolio, is Warren Buffett. And Warren Buffett, we know whatever he touches goes to the moon, right? So recently he bought it, and then obviously it went up about 12%. But this is a company I used to own in my portfolio, $400 billion market cap. And it has a wide economic mode, $82 per share. At the time when I sold it, I think it was $130 or $120 per share, but it's gone down quite a bit since then. Dividend yield, my concern was always the situation between China and Taiwan Semiconductor, or Taiwan just a country. So for that reason, I just got out of it. And I do own quite a lot of semis in my portfolio anyway. The latest earnings is about 10%, 5-year growth rate 9%, payout ratio 30%. Payout and dividend streak is about just 3 years. Safety 62%, profit margin 42%, return on equity 36%. Free cash flow looking about $16.8 billion. And then in terms of total return in the last 10 years, we're looking about 19%. Next 5 years, they're expecting about 22% growth in terms of earnings, 40% discounted right now. Their price target is $133 per share. So that's a massive upside. If you're thinking about adding a company to your portfolio, you might want to do a bit more research on this company, because I do genuinely like that company. It's a great company, but the situation in China and Taiwan is a bit funny. So I don't know where it's going to go. So for that reason, I'm out. Okay. In terms of next company is Nike, $162 billion market cap. It has a wide economic mode, $105 per share. 1.28% dividend yield. Latest dividend increase is 11%. 5-year growth rate of 11%. Payout ratio only 34%. And dividend growth streaks 20 years. Safety 99%. 12% profit margin. Return on equity 37%. Free cash flow, we're looking at about $3.5 billion. Total return 17%. Growth in the next 5 years is expected about 7%. 20% discounted right now. $129 billion dollars per share. That's the target. Next company is a company that I own in my portfolio, and that's Merck. This is a pharmaceutical company. They do a lot of drugs and that are used for cancer and so on. $268 billion market cap. It has a wide economic moat. $106 per share right now. I can't believe it's gone 100, because when I was buying this company it was 70 something dollars per share, and I used to talk about it a lot and say this company is undervalued, but look at it right now. Dividend yield 2.58, which is really nice, good spot there. Latest dividend increase is 6% and 7% 5-year growth rate. Payout ratio only 36%. 10 years of increase in that dividend. Safety 99%. 25% profit margin. Return on equity 36%. $15.2 billion of free cash flow, which is absolutely amazing. Total return 11%. Growth estimate in the next 5 years about 12%, which is very high for a pharma company. Fairly valued right now, $97 per share is where it should be. So as you can see, it's gone up a little bit more than basically what the fair values are. The next company is Home Depot. This company is home improvement retailer or company. $324 billion market cap. It has a wide economic moat. $324 per share. 2.3 dividend yield, 15%. Latest dividend increase is 15%, and then the 5-year growth rate is 18%. Payout ratio 44, which is quite low. 13 years of increase in that dividend. 87% dividend safety, which is absolutely fine. Anything above 61, they say, is absolutely fine. Profit margin about 10%. Return on equity is not there right now. Free cash flow here is $10.8 billion. This is not there because of something called negative equity. That's the only reason. There's nothing to worry about. Total return is basically 19% in the last 10 years, and almost 16% expected. The earnings are expected to grow about 16% in the next 5 years, every single year, and 19% premium right now, $267 per share, where it should be right now, as you can see, is $324 per share. The final company we're looking at today is a company that reported their earnings yesterday, and that's Medtronic. Medtronic is basically a pharmaceutical company that actually does a lot of the equipment side of things. $109 billion market cap. It has a wide economic moat. $77 per share. And right now, when they reported yesterday, one of the things that happened is their earnings was actually, the revenue was down a little bit, and because they had some issues with supply chain and what's happening in China and the dollar being strong and all of these things, right, and a couple of the internal situations, basically they missed their earnings, and for that reason the stock went down $77, which is very good for me, and I'll show you how much of this company I own and what I plan to do in the next few weeks. Right now, in terms of dividend yield, we're looking about 3.5%, which is really good. Dividend latest dividend increase was 8%. 5-year growth rate of 8%. Payout ratio 48%. 44 years of increase in that dividend. Safety 99%. 16.8% profit margin. Return on equity about 10%. 5.7 billion of free cash flow. 8.9 or let's call it 9%. Total return in the last 10 years, 3.2% expected growth in the next 5 years, and then 30% discounted right now, $112. It used to be, okay, they have only changed this last night, basically was $122 per share. Morningstar changed it to $112 because of the situation, because of the earnings coming down on what the company said. Now, if you own these companies, you would be, in terms of dividend yield, sometimes it's not about the yield. These are quality companies. Every single company in here has a wide economic moat. They have excellent free cash flow. They pay dividend that's absolutely safe. And they seem to be a lot of them cheap right now. So when you buy these companies, you're not really worried about the dividend yield, because if you, on average, you basically get 1.8. If this was your portfolio, your average dividend yield will be 1.8, which is quite low if you're thinking of retiring on that money maybe in the next 5 years or so, right? But the increases to 12 years, the 5-year growth rate is about 12%, which is really good. So yeah, in terms of the companies here, they are all quality businesses. They are basically mega companies. They are huge, and that's probably why these guys own these companies. It's not just the basically the price appreciation. The dividend is great in terms of the profits and so on is good. They have an excellent free cash flow, and the expected returns are very good. Apart from Medtronics, is actually a majority of them are very high, right? So it is quite really good set of companies. I looked at this list. Okay, all of these companies is basically companies that are owned. Basically, some of them I do own in my portfolio. For example, Adobe, for example, 11 super investors own that company, whereas companies like Microsoft, when you look at it, 28 people own. When it comes to Google, for example, 31. When it comes to Amazon, when it comes to Google, different clouds, obviously. What else is there? There we go. Visa, 25 people. 20 super investors, 17, and so on. So there's a lot of companies on this list, okay, that these super investors own, and the reason they own it is because of these quality, because they've done the research and so on. So just to be transparent, I'm going to show you the companies that are on that list that I actually own in my portfolio. So I do own Home Depot. Okay, I've talked about it before. If you want J&J, I do own Medtronics. As you can see, I'm down about 14%, but I will be buying more of this company because my average is right now $97 per share. So I want to bring that down. So I will be adding to it. Merck is another company. Microsoft is another company that's in that section. What else do I own that's in that list? I think Visa, there you go. I've owned Visa, 10 shares of Visa for a long time. I can't even remember last time I actually bought this company. Let me show you. The last time I actually bought 2 shares was December 20, so it's about a year ago. Wow. Okay, so about almost 1 year ago, that was the last time I actually bought this company. I added to the company. Anyway, that is what I wanted to share with you guys. I hope you're having a great day. If you like this type of content, please, I don't promote these videos and things like that as much as I should, because I'm very busy with family and work and so on, and I'm trying to share my journey with you guys and help you guys to understand what could potentially, like, by doing this research, it takes a lot of my time. So I would really appreciate if you can just give the videos a like. Have a wonderful day. Assalamu Alaikum.